The most expensive mistake in markets is not usually ignorance. It is reacting to the wrong thing. Most people see a war headline, an inflation headline, a tariff headline, or a central bank headline, and they think the job is to predict the event. They want to know whether the conflict will escalate, whether oil will hit some dramatic number, whether the Fed will cut in September or December, whether the next headline will sound more cheerful or more terrifying than the last one. That is how ordinary people approach uncertainty. Institutions do something different. They ask where the money is going. That is the real question. Not what the event is called, not which politician is pretending to control it, not which television anchor sounds most certain this week. Where is capital leaving? Where is capital entering? Which sectors are being abandoned? Which industries are being accumulated quietly while the public is still frozen between panic and confusion? That is the game. And I think a great many investors are dangerously unprepared for it right now because the surface of the market looks much calmer than the structure beneath it. The S&P 500 is flirting with records. Bitcoin is pushing higher. Parts of the market are acting as if the world sorted itself out, and yet the deeper backdrop is one of the most uncertain I have seen in a very long time. Tariffs are changing the rules of trade. Oil has already demonstrated how quickly it can spike on geopolitical stress. The dollar is weaker than many expected. Inflation is still sticky enough to trap policymakers. Global growth is softer than people want to admit. And the Federal Reserve is stuck in the familiar but unpleasant place where every tool fixes one problem by worsening another. That is not a stable environment. That is a market standing on a complicated floor while pretending the floor is solid. Now, whenever the floor starts behaving like this, retail investors usually commit one of three self-inflicted injuries. The first is what I would call the cash panic. They sell everything. They move to cash. They tell themselves they are being prudent because cash feels calm and temporary and emotionally clean. They think they have stepped out of risk. In reality, they have often stepped into a different form of loss. If inflation is running above what cash earns, then they are accepting a guaranteed erosion of purchasing power while hoping the comfort of stillness will compensate them for it. It rarely does. Worse, if the market stabilizes or rotates upward without giving them the dramatic re-entry they imagined. They miss the recovery while keeping the inflation tax. That is a very expensive version of safety. The second mistake is paralysis. This one is quieter, but just as destructive. The investor does nothing, not because he has a plan, but because he cannot tolerate the number of variables. He is overwhelmed. He tells himself that not making a choice is wiser than making the wrong one. But if the environment has changed materially and your portfolio was built for a different environment, doing nothing is still a choice. You are not avoiding risk. You are simply refusing to examine it while it compounds in the dark. The third mistake is chasing the spike. That is the most seductive one because it disguises fear as action. Gold moves sharply. Energy moves sharply. Defense names jump. Some thematic corner of the market suddenly becomes the story of the week, and retail money piles into it after the move, not before it. The institutions that studied the pattern and positioned early are already sitting on gains. The late buyer is simply paying them a premium for being late. That is why first phase spikes are often terrible entry points for the public, and very good exit or trim points for smarter capital. These three mistakes happen over and over because people are reacting to the visible event rather than the underlying flow. I have never thought the event itself was the main edge. The edge is understanding the sequence. When uncertainty explodes, markets usually move through a very recognizable pattern. First comes the shock. This is the emotional phase, the first days, maybe the first weeks. Fear is fast. Algorithms react. The broad market sells off. The volatility index jumps. Oil surges, defense, and some obvious conflict. Linked areas leap because they are the easiest places for frightened money to run. This is where the public feels most certain that something must be done immediately, which is why so much bad action happens here. Then comes repricing. This is where more serious money begins asking better questions, not how bad does this sound, but how long can this last? What does this do to inflation? What does this do to margins? What does this do to the Fed? What industries actually benefit after the first panic fades? The repricing phase is where institutions stop reacting and start rotating. Then comes rotation. This is the phase the public misses most consistently and most expensively. Once the obvious fear trades have had their first burst, capital begins moving toward the structural winners of the new regime, not the names that spiked hardest on the headline, but the industries with durable tailwinds under the new conditions. That rotation can last quarters, sometimes it lasts years, and because it is quieter than the original shock, it attracts far less public attention, yet that is where a great deal of the money gets made. That is why I keep saying you do not need to predict the war. You need to understand the flow. Now let us examine the current flow. The first major variable is oil. Oil matters because it is not merely a commodity, it is an invisible tax on everything. It touches transport, freight, manufacturing, logistics, packaging, agriculture, airlines, chemicals, construction, and household budgets. When oil spikes, the pain does not stay in one sector, it moves. It changes the cost structure of many businesses that never drill a single barrel. That is why I always ask first where oil is going. And, more importantly, what the market has already priced into the sectors most sensitive to it. The obvious first reaction to an oil shock is to buy energy producers. Sometimes that works in the short run, but often the better follow-through lies a little deeper: pipelines, storage, midstream infrastructure, refineries, oil services, the parts of the energy chain that benefit not merely from the headline price spike, but from the durable need to move, process, store, and service the system over time. That is where institutions often go once the public finishes screaming about the spot price. The second major variable is inflation and the Fed. This matters because high oil trade friction and weaker currency all lean in the same direction. They make inflation harder to kill. But weak growth makes aggressive tightening harder to sustain. That is the Fed's trap. If it cuts too easily, it validates inflation risk and weakens the dollar further. If it stays too tight, it pressures an economy already losing momentum. The market knows this, which is why sector behavior becomes so important. Some industries thrive when inflation stays sticky and money gets easier later. Others get crushed because they need low rates, cheap inputs, or flawless consumer demand just to maintain their current valuations. That is the third variable, earnings risk. Stocks are not one thing. The stock market is not a giant bucket where everything rises and falls for the same reason. A stock is a claim on future business earnings. So when the environment changes, you must ask which businesses are structurally stronger and which ones are merely more expensive stories waiting to be repriced. This is why I distrust simple statements like, the market is near highs, so things must be okay. Okay for whom? A software name priced for perfection is not the same thing as an energy infrastructure business benefiting from long-duration capital spending. A consumer discretionary company selling nice to have goods is not the same thing as a staples business selling products people continue buying even when they hate the economy. An airline is not the same thing as a defense contractor. A gold miner is not the same thing as a bond proxy utility. Lumping them together because they all have tickers is intellectually lazy and financially dangerous. This is why institutions think in sectors and industries. They know money does not leave the market all at once nearly as often as people think. It moves within the market from weak margin structures to stronger ones, from long-duration dreams to hard asset cash flow, from fragile consumer exposure to defensive necessity, from crowded narratives to neglected but structurally advantaged industries. That is the real map. And right now, several areas look much more interesting to me than the average investor seems willing to admit. Energy infrastructure remains one of them, not because oil will rise forever, but because instability, underinvestment, and strategic energy security all make the broader energy system more valuable. Pipelines, terminals, transport, storage, and related services are not as glamorous as the first movers. But glamour is not what I am after. I care about durable money flow. Defense is another. The public always looks first at the giant defense names because those are the ones it recognizes. Fine. But the more interesting question is often where the spending goes after the announcement components, sensors, specialized electronics, drone systems, AI, linked battlefield systems, cybersecurity and defense, linked software once a defense cycle begins. The first beneficiaries are visible. The deeper beneficiaries often emerge later and then run longer because the market needed time to understand who is actually selling the picks and shovels to the new spending wave. Gold and the broader gold ecosystem also matter. A weaker dollar, central bank demand, geopolitical stress, and sticky inflation all push in that direction. But here again, the lazy version of the story is simply buy gold because fear is high. The more thoughtful version asks where the flow goes after the initial fear trade. Physical gold ETFs, miners, royalty companies, streaming companies, and related names do not all behave the same way. Some are trading vehicles, some are leverage on the metal, some are strategic stores of distrust in paper systems. A serious investor distinguishes among them. Consumer staples are another quiet winner in this kind of environment. People mock staples because they are boring. I like boring when the world gets expensive. Food, beverages, household products, basic necessities, those things do not stop selling because a macro strategist gets nervous. Better still, many of those businesses retain some pricing power. They may not thrill anybody, but they can protect capital better than far more exciting companies whose products are optional. Now, let us look at what tends to suffer. Airlines are obvious because fuel hurts them immediately. But more broadly, consumer discretionary businesses get squeezed because households start cutting what they do not absolutely need real estate and utilities, which many people lazily label as safe, can suffer when inflation is high and rates stay elevated because their economics and valuations do not love that mix. Growth names with heroic multiples can look very strong until the market remembers that higher discount rates and slower real growth are a very poor environment for expensive promises. This is why I think a great many people are positioned incorrectly. They still think in old categories. Cash means safety. Utilities mean defense. The broad market near highs means all is well. None of those statements can be trusted blindly in a regime change. And there is another variable people keep underestimating. The dollar, a weakening dollar, is not just a currency story. It is a repricing signal for almost everything. Gold tends to respond. Commodities tend to respond. U.S. multinationals with large foreign earnings can benefit because those foreign earnings translate back more favorably. Emerging markets can benefit because dollar weakness eases some of the pressure on dollar-linked financing conditions. The dollar is a canary. When it moves materially, it tells you that global capital is adjusting the terms on which it wants to hold paper claims. That matters tremendously. Too many American investors remain overconcentrated in pure dollar assets because the old order rewarded it so generously for so long. But old rewards do not guarantee future wisdom. If the dollar is weakening while inflation is sticky and global uncertainty is extreme, then owning nothing but dollar cash, long bonds, and a generic pile of domestic equities is not prudence. It is concentration disguised as normality. That is why I think one of the most important habits in a time like this is asking the questions institutions ask before they buy or sell anything. What phase are we in? Where is oil going? What is inflation doing? What is the Fed likely to do in response? What is the dollar doing? Which sectors have real earnings resilience? Which sectors are being repriced too slowly? What is the market not fully pricing yet? And what is my time horizon? That last question matters more than people think. A trader and a long-term investor can both be right and still lose money by using the wrong position for the wrong time frame. If you are trying to trade the first shock, your behavior will differ from someone positioning for the next 2 years of structural rotation. Confusing those horizons is one of the easiest ways to turn correct analysis into poor execution. Now, I want to say something important to the ordinary investor. You do not need to become a Wall Street banker to survive this. You do not need a Bloomberg terminal. You do not need a secret chat room. What you need is a framework strong enough that you do not panic, freeze, or chase the wrong thing at the wrong time. Most bad outcomes in markets are not caused by lack of information. They are caused by lack of structure. And structure is learnable. It begins with accepting that the market is not one monolithic thing. It is a living circulation system. Money leaves one set of businesses and enters another, sometimes violently, sometimes quietly, but almost never randomly. That is why informed investors do not simply ask whether the market is up or down. They ask where the winners are being selected. That is the whole game. The present environment is extreme by historical standards. The uncertainty measures are extraordinary. The cross-currents are violent. That does not mean the only correct move is fear. It means the only correct move is discipline. That is very different. Do not dump everything into cash and call it wisdom. Do not shut your eyes and call it patience. Do not buy whatever just ran 60% and call it positioning. Instead, learn the flow, follow the rotation, watch the dollar, watch oil, watch inflation, watch where earnings are likely to hold up. Watch where money is quietly building. Not just where it already exploded. That is how you keep from becoming the sitting duck in a market like this. Not by predicting every headline, by understanding what money always does when the world gets uncertain. It runs somewhere. And if you know where it is likely to run next, you stop behaving like the public and start behaving like an owner of capital. That difference is where fortunes are either lost or made.